All right, everybody. How you doing, David?
I'm doing well. How are you
Yeah.
doing? How about those Knicks?
Man, long-suffering Knick fan. We got a little brief moment of joy during the Carmelo era, and before that, it was obviously Patrick Ewing and Latrell Sprewell, Allen Houston, Oak, Mace, all that great time period in the 90s. This is my favorite Knick team since the Ewing era. And it's right up there because the heart they play with, the grit. None of them were a top 15 pick. We're taking apart the MVP of Philadelphia, but I just want to say to the people of Philadelphia, you're the sixth borough now. We own you. And that's it. It's our town now. I'm joking. That was my tweet the other day, but
did you make it to any of the games?
I don't go to any Knicks games during the year. I used to have season tickets, so I kind of treat myself because when they get to the playoffs, I save up all my Knicks ticket budget for the playoffs, and I made friends with a guy named David Adelman, who's a really, really gentleman and fun guy, and we met. Actually, you remember the party we had in at iConnections
Miami
conference in Miami? Yeah, he was there at that party, which was a pretty cool party. I mean, don't say where that party was, but in terms of elite attendees, that was pretty crazy.
Yeah.
And so my friend Antonio Gracias from Valor introduced me to him, and we've been texting back and forth about the Knicks in Philly, and we had a dinner bet. Two of us, one pays for dinner, and so then he asked me, "Am I coming to the game?" And I talked to my wife, and I was like, I just got invited to the game. I'm kind of making this new bromance. And so sure enough, she gives me the pass to go, my Knicks Hall pass, as it were. And I zip to Philly. And I'm going to buy a courtside seat for myself, but there were 4 seats behind the Knicks bench. That's my favorite seat in the world. Like when I go to the Warriors game, I love the seats right behind the Warriors bench because I'm into the game. I like to see them draw the plays. Yeah, I want to be like I'm the coach, or an owner someday. And so I'm there, and game 4 was unbelievable after like games 1, 2, and 3 being unbelievable. And then I went to the Garden for game 5, and I watched that 4-point play and that whole thing. And then I was going to go, but I had to get back to my kids, and I was going to go to the game last night. But I think it's taken about 4 years off my life. But man, that was one of the best series I've ever seen in my life. And I just think that kid Maxey is an all-star, man. There's a lot of upside there. And Joel's a warrior. I mean, I didn't like some of the dirty plays, if I'm being honest, but what a series. Do you watch the series? Hey, you guys?
I did, and now it's Knicks Pacers. Pacers are my team. So you talk about the 90s.
Okay.
That's my childhood.
Well, I didn't realize that because
that's the highlight of my childhood. Yeah.
Oh, it's Reggie Miller on the Pacers. So anyway, I mean,
Reggie Miller.
We were going to sweep the Pacers, obviously. But I'll talk to Brunson on the group chat, and I'll just let him know we'll do the gentleman sweep. We'll let you split a game, okay? When we go to your arena, we'll let you win one, and then we'll just do the 5 game sweep.
We'll let the games do the talking.
Oh, do you want to make a dinner bet, David? Would you like to get in on the action? Because J-Cal's going to be yum eating.
I have looked up the odds. They're slightly
okay,
in your
so straight
favor.
up dinner bet. Max per person is $1,000.
Okay.
Per person. So it's basically like a 2-dime bet. That's not the bet I made with David, by the way. It's just we're like going to do Philly cheesesteaks or New York pizza. But you want to make the Nobu? You want to make the omakase bet? You feeling bold, David?
Straight up. Let's do it.
Okay, there it is. Omakase bet. Omakase bet. And, listen, that can get dangerous. All right, can we start the show here? We got so much to talk about. Big week.
Let's get started. Welcome back to this week's Liquidity Podcast. With me today, I have Joshua Berkowitz of Corp, a family office LP, and to some of the top VCs. Next, we have Donald Stalter, partner at Global Founders Capital. And of course, we have Jason Calacanis from the Launch Fund. I'm your moderator, David Weisburd, co-founder of 10x Capital. Today, we have a really exciting show. We have several interesting topics on the docket. We have Elon, your friend, Jason. His OpenAI competitor has raised $6 billion. Now we have data suggesting that VC emerging managers in the first 3 vintages of their fund are outperforming established managers. And we'll end, of course, with everyone's 3 latest investments. Let's dive right in. Elon Musk's AI competitor to OpenAI, xAI, has reportedly increased its round size to $6 billion for their upcoming raise. Jason, you and the besties discussed Zuck's scorched earth strategy on the All In podcast. What do you think about Elon's aim with xAI?
Well, I don't have any inside information. Disclaimer here. Just zooming out a bit. I think what we're realizing is a lot of these LLMs are going to be commoditized, right? And they're going to do an equally good job at whatever your task is. So we've seen this with Meta releasing their open source project. We saw it when Claude leapfrogged, ChatGPT 3.5. So what I see from startups is they're willing to swap these things in and out. So then what's left? I think, having a unique data set, say Twitter, Reddit, Gmail, if you're allowed to use Gmail, I'm not sure. YouTube, I'm not sure what their terms of service allows them to do. So being able to have a unique data set combined with that gives you the ability to make a unique product in the world. But there's a big gap between how much money is being spent and the amount of revenue being generated right now. So some of these companies are losing very large amounts of money because it's so capital intensive. And it's going to be a war of attrition. And I think that's what we're starting to see here is who can raise the biggest war chest, who can build the biggest cluster, who can have the biggest data set. And it looks like, licensing data sets is becoming something that OpenAI is starting to get better at. I saw this week they did FT. Obviously, they're at war with the New York Times, who could probably win an injunction against them, I think, given how dead to rights they have them. So you put all that together, there's going to be 3 or 4 at-scale players here, and then there's going to be a bunch of open source verticalized ones. I'm happy to leave those giant opportunities to the giant players, sovereign wealth funds. It's not a venture game. This is a game for Amazon, Elon, Tim Cook, Sundar. This is not a game for VCs and most LPs. There's a rarefied air of LPs, specifically sovereigns, maybe on the margin, some high net worth individuals, like let's say a Larry Ellison who likes to make bold bets, but most high net worth individuals, they don't like to make billion-dollar bets. And so it's going to take a lot of money. It's going to take a lot of time. And I think what everybody's playing for is, some version of AGI, a generalized intelligence. And so I've told people before, never underestimate Elon, since we've been friends for close to 3 decades now. Not the person you want to underestimate. He will be the number 1, 2, or 3 player in this. And if you make this bet, and this is not investment advice, you will have bet in the number. I think by default, if you back Elon, you'll win the gold, the silver, or the bronze. And if you look at his companies, he got the gold with Tesla, got the gold with SpaceX. So, and I think, Neuralink is a little bit young right now. I think there's the medals haven't been given out yet. Pretty good track record of winning the gold. So if you're going to place a bet, that's probably the best possible individual you could place a bet on. And I'm not just saying that because we're besties, but it's just the objective fact, right? I'm interested in what our panel thinks.
Yeah, I think the difference between this one and his other companies is this one, he's coming from behind. With Tesla, it was effectively the first electric car company. With SpaceX, it was the first private rocket company. I think the same goes for the Boring Company, Neuralink too. So he's got a big lead to come back from here. And his competitors are also super well funded. So not saying you can't do it. It's always scary to bet against Elon, but I think the starting position is very different here than in the past.
That's a great point.
Yeah, I'd agree with Josh on that. At the same time, it's interesting. Elon's got this network of Tesla, Twitter, Neuralink, Boring Company, and all these others who he's umbilically connected with. And so he's got this proprietary data set, especially from X, where he's able to kind of build out Grok. He's got sort of this open source platform, good luck Mistral. I feel like, he's going to be able to leverage a lot of his network to, come at it from a completely different angle. I think, he's a sci-fi fan, obviously, and thinking about Neuralink and its connection, to this new technology is exciting, if not a little bit scary. So, I think there's a massive vision behind this that we're probably all not that familiar with. But, if you Google it, if you read online about it, there's definitely something exciting ahead.
Yeah, I know nothing, but I think that's also a good point. In terms of coming from behind, he was the co-founder of OpenAI. So in a way, he kind of was first to the party again. It just got a little weird with this open source turning closed source, et cetera. Another major issue here is what's going to win the day, open source or proprietary data. You can look at a lot of different categories and say open source wins, but there's a lot of categories where being closed wins. You look at Google search, that's a closed, black box of a system. Same with TikTok, same with Facebook. So a lot of these consumer products are closed black boxes. Then you look at the tech stacks, it's obvious that a lot of the open source projects just demolish everybody. And we're seeing that in corporate America now. So we do have to think about, if you're in corporate America and you want to compete, pick a company, LVMH, I don't know, Walmart, any company, and they need AI. They're going to use a proprietary platform where they're going to just get charged more and more, or they're going to be locked in and they're, could get rug pulled. Or I think it's going to say, screw it, I'm forking whatever's on the open source deck, right? And I think in decade 3 of corporate America embracing open source, and man, I remember the early days where the IT departments laughed at it. We'll never use that, blah, blah, blah. And then all of a sudden it was like, hey, for this small project, we use this MySQL open source. We use WordPress for this publisher. Hey, we tried this thing over here, this Linux thing. Hey, we're using some open source storage cluster. We got this Hadoop thing going. And, they use it for some small project. Like, what did it cost? And it's like, well, it's open source. It doesn't cost anything. It's free. But where's the license bill? It's like, no, we're hosting it on our servers. It's basically free. And they're like, oh, can we get some support for that? They're like, yeah, there's a couple of companies that can support us, or we can just hire 2 people from the open source project. Here's a list of the people working and contributing on it. And they're like, oh yeah, hire 2 people. So now corporate America knows this movie, and they know it's actually safer in a lot of instances to go open source. So I am fascinated to see if that plays out here. I'm interested in what you think, David.
One way to look at this that's really drew my eye is Sequoia is leading a $6 billion round at an $18 billion valuation, essentially for an early stage pre-revenue business. And you kind of step back and think about why is Sequoia doing that? And the first thing that you really have to come to grips with is this is not a venture investment. This is a traditional growth equity investment. So a very different dynamic. With a venture investment, you're trying to get the 100x, you're trying to return the entire fund with a power law outcome. With a growth equity investment, you're trying to get more of a 3 to 5x with downside protection. But then you look at it and it looks absurd, because how do you price in downside protection into a pre-revenue and early stage company? And then you have to really look at Elon's track record. Jason, you mentioned SpaceX, Tesla. He's also had, basically since PayPal, none of his projects have actually failed. If you look at Solar City, Boring Company, Neuralink, even OpenAI. So I think Sequoia is really making a bet that this cannot go down to zero, that there is going to be terminal value and downside protection. Of course, they're investing on a preferred share. But it is interesting to look at Elon, how he's able to attract this amount of capital for a pre-revenue company. And the next war is obviously going to be, can he win the war for talent? If he's able to win the war for talent against Anthropic and against OpenAI, he will be able to catch up very quickly. If he's not, I think he is going to have trouble here.
Probably, it's a dogfight out there for talent, but people want to work with Elon, and the hardest working people want to work for Elon, and the people who are phoning it in are not going to last working for him. So he's got a really interesting approach, which is like, you're all in or you're out, right? I think might be one way to say it. And, be as committed as he is. And, his commitment level is second to none. He's just a samurai in that regard. And so, and back to my analogy of gold, silver, bronze, like if he gets the sense he's in second or third, he's going to go into beast mode to get that gold. And, I don't know you could say that about a corporation with a hired gun CEO, right? They don't have founder authority. They don't have the drive. So I like your assessment, David. There's some downside protection here. The track record.
I think also on the fundraising side, he's sort of done, Elon's like two hype cycles in one with this, right? There's the whole LLM hype cycle where tons of family offices and institutions suddenly feel like they need an allocation to one of the big LLM companies. And that's sort of pushing capital into the space to almost all of the companies that are raising here. And then you have Elon himself, who is a known quantity. Lots of people want to back all over the world. And you put those two things together and you create a situation where there's so many pools of capital all over the world that want into this thing. And I've spoken to lots of big family offices that I would never expect to be interested in something like this, but because it's Elon, because it's LMs, you put them two together, they feel like this is something they want to be a part of, because it's just sort of so of the culture and of what's hot right now, rightly or wrongly.
Yeah. I was also going to say, I think it's downside protected given its connection with the Teslas, the massive public company that has, huge balance sheet. So ostensibly, a strategic investment or whatever, could be in the cards. Elon can make decisions that no one else can as part of this business. So I feel like there's just a really interesting, very powerful sort of virtuous cycle.
What do you think, Donald? You're on more cap tables than 99% of Silicon Valley. What do you think about Sequoia being in OpenAI and then backing its main competitor, xAI? How do you look at that?
Look, I mean, I think that Sequoia is in the business of making money for its LPs. And I think, sort of cut and dry, they've been very, very successful with Musk over time. They've made money, as you said. And I think they probably also believe that they're going to make significant money on OpenAI. OpenAI is connected with Microsoft on another level. Sam's a force in nature. So I just view it as an economic decision more than anything else.
Moving on. PitchBook just released a report titled Establishing a Case for Emerging Managers. In it, PitchBook presented compelling economic case for investing into emerging managers, which are managers in their first, second, and third vintage. Empirically showing emerging managers have outperformed established managers between both the top and bottom quartile. Joshua, I know you're very active in the emerging manager space. Why not just invest into the large multi-stage firms? And tell me a little bit about your strategy.
Yeah. So first, I would put this report in a category of reports that let's run a correlation, report the results of the correlation, and then make a whole bunch of inferences from that. And so from the GP standpoint, it would be like, hey, there's a bunch of successful founders from Stanford. So let's only invest in Stanford founders or MIT founders or Waterloo founders or pick your whatever. And so, yeah, there's a lot of really successful emerging managers. Of course there is. Does the fact that there's a positive correlation means you should only do one or only do the other? I mean, I think it's just sort of a really big oversimplification. It's interesting data, but I think it's one of many, many data points that should sort of help you figure out who you should back and why. So I just sort of start there. And then you go, what other data points are super big influences to this? Well, we know venture is a power law outcome. We know that the best venture capital funds tend to persistently outperform year over year. We know that most of the returns fall to the top 10% of venture capital funds. And so each of those different correlations tends to push you to a different category of firm to back. And which of those categories you want to back depends on your situation and status and who you have access to, right? And so if I had access to Sequoia, yeah, it would probably make sense for me to put a ton of money into the big, large mega cap or mega VC fund like Sequoia. I don't, and most LPs don't. And so you end up playing a different game, trying to find really talented emerging managers to back. And luckily, they can perform really well too.
And how do you know? A lot of people know about VC's portfolio construction, but as an LP, how do you construct your portfolio of managers?
I tend to think the right mental model for an LP is you're investing in the underlying companies and you're using the GPs to do that and paying them 20 to 30% of the profits for the privilege. If you believe that venture follows a true power law outcome, then what's unique about a power law distribution is that the more N you have, the bigger your sample size. In other words, the more investments you make, the higher your mean return. Very counterintuitive. It doesn't work that way. So as long as you can invest in great companies, you think you should invest in more of them rather than less. And so on balance, I try to have a very diversified portfolio as long as I can invest and find top GPs who I think are investing in top companies. That's sort of subject to administrative headaches and the relationships I can maintain and what have you. But I sort of believe more is better subject to those types of constraints. And so that for me ends up being about 10 to 15 funds a year.
Jason, you're in a couple dozen funds yourself as an LP. What's your breakdown of emerging versus established managers?
Yeah, I'm in two of the highest profile mega funds as a friend of the fund. When you're a GP who can provide deal flow, you can get some kind of unique access to those ones that are like the classic large ones. And then the rest is a long tail of 25 to 250K checks. And the reason I do it is I like to build those relationships and understand how emerging managers are looking at the space. In other words, it's really not even for deal flow, because our deal flow is second only to Y Combinator's. We're getting 20,000 applications for funding now. So we're getting so many applications for funding as a 21-person firm that my team has said, please stop tweeting that we have meetings open next week, because we want our response time to be reasonable. We've now gotten it to 200 applications to one investment. YC is investing in 1%. We're now to 0.5. And the reason I did that was after a long, heartfelt discussion with Ruloff at Sequoia. And he told me what I was doing was, he's been mentoring me for a long time on this. I was obviously the first Sequoia scout. And Moritz and Doug Leone, and getting to watch, Jim Getz and all this group, and obviously Bill Gurley. As you increase the deal flow, and I say this thing all the time to new fund managers, I tell them deal flow is destiny. It's like deal flow is destiny, or deal flow is your denominator. And the more you can look at, and the more you say no to, the ones you do say yes to have just more elite criteria. And so the other goal I've had is to get up the number of meetings. And I do learn some things from emerging managers about their approach. But what I found recently is, I'm kind of doing it to pay it forward, because the lessons I'm getting are not, they're neophytes in a lot of cases. They're figuring it out. So I'm getting less and less of like the knowledge exchange. And so therefore I add one per year, one new manager per year. I get probably 300 or 400 people contact me. It's nice to look at the deck. My team meets with 10% of those. So we meet with maybe 30 a year, and we pick our favorite. And so, I don't want it to be a distraction for me. I don't do the meetings. My team does them. And it's an intelligence, wisdom generating effort for us. It's a way for us to just participate. We have a saying that Michael Moritz told me very early on, maybe 20 years ago, no conflict, no interest. And so, if you have some conflicts, right, and you're both competing for deals, and I'm an LP, like that messiness from the outside is actually a way of building a really deep web and not missing deals. So, when somebody's like, I'm like, oh, who's investing? I'm like, oh, this person. I'm like, oh, I already have shares in your company from these two funds. That's really powerful, right? So now I'm already on the cap table. I can have a really thoughtful discussion. I also think these emerging fund managers today are scrappier and more resilient. And I would tell you it was the opposite for the last 5 years, or 5 years before. I'll put everything as Silicon Valley Bank bankruptcy, like BSVB, ASVB, right? That I use that as my like before and after Christ. Before,
love it.
Yeah.
SVB went down. There's a lot of folks who were playing the role of venture capital. It was almost like cosplay. They're like sending me these updates, and I'm like, I forward to one of my managing directors, and I'm like, oh, are we an LP in this? And then the person, I'm like, no. I'm like, oh, I tell the person, hey, you sent me this update. He accidentally put me on the distribution. He's like, oh, no. I have like 300 people on it who are LPs. I'm like, why? You're giving this data out or whatever? And he's like, yeah. And they were up 7x on paper, like year over year, because of some crypto investment. I was like, if you're 7x, sell half that position, DPI 3.5. Lock in the win. He's like, oh yeah, no, our tokens are locked up. I'm like, for how long? 5 years. I'm like, how much can you sell? Can you put it into an SPV? How do you sell some? Of course, that went to zero. So, the lessons after 400 investments, I'm on my fourth fund plus the Sequoia fund. So I would put the first three together. So I'm kind of on my third fund. I'm just leaving emerging. I'm like kind of on the, the doorstep of being established versus emerging. And I like the ones raising money now. If you can raise 5 million, 10 million now, Sophia Amorosa comes to mind. Other folks are out there grinding. Love those grinders.
Yeah. I mean, I'd agree with you. We've invested in maybe 20, 25 funds, emerging managers, and the ones prior to the market crash were definitely more of the hand wavy type. They weren't as hungry as dogs. As we see right now, we've got all these just hard fighting emerging managers who are kind of bashing down doors to get into deals, learning about all the new industries that are emerging so rapidly and just getting their clutches onto the best opportunities. And, they're already inside companies like Stripe, talking to people on the engineering team, figuring out who's going to spin out. They're already inside of OpenAI. So some of those emerging managers are really, really good. The ones that have kind of, come out over the past 3-4 months. I find that, there's been pretty big generational shift with some of the larger venture funds, the multi-stage funds, where, maybe they're not as hungry. Maybe they're, looking at sort of fewer opportunities and doing a lot more portfolio management. So from a deal flow source standpoint, the new breed of emerging managers has been fantastic, I've found. And, I think philosophically, the piece that PitchBook put together, would align with that. From a statistical standpoint, it's probably just a, small portion of emerging managers who are really that scrappy, who are really that good.
Yeah, when you see Carta, PitchBook, all these folks putting out data, they all have partial data. I would not. It's no dig to either of those companies. I'm just saying
survivorship bias.
Yeah, there's the data is incomplete. So they do PitchBook. They do the best they can. But I'm more like talking to GPs, and then you'll get a better sense of this. What I'm seeing, because we have a list of 11,000 investors in the syndicate.com, our syndicate investment club, 4,000 have done an investment. And then we have a list of 2,000 venture capitalists from the top funds in a Google sheet that we just give to our founders when they're in our accelerator or founder universe. After we invest in them, we give them that sheet, and we have a fundraising process, mentorship process that we talk to them about. And I invited all of those to the Liquidity Summit, and we just did an email. I was shocked at the number of people whose email addresses were no longer working, or I'm no longer at this firm. I think there's probably been an attrition of between 10 and 20% of managers at funds. And then there's probably another 20% to go that are kind of window seating or babysitting and just living off the trickles and of the management fees. And they're basically zombie funds. I think we're going to identify the zombie funds pretty quick, because we as a fund, when we introduce people to them, we say, we look for their last investment. It's a little trick, right? If we're going to forward somebody to another fund, we just try to figure out what their last investment was and the date of it.
Well, I think just also understanding how the ecosystem worked. In 2021, it was very easy to raise a fund. Tons of people did it. Venture capital became a very cool thing to do. And a lot of it was also enabled by all the liquidity in the growth stage, and that you had wealthy executives and early employees that were happy to plow the money back into the ecosystem. And often the way they did it was through emerging managers that were sort of tourists in the ecosystem. I think all of those folks, if they haven't washed out already, are going to wash out in the next few years. And while it will be sad, it'll also probably be much healthier for the ecosystem to get back to the people that, that really, really do want to do this. They're committed for the long term. And quite frankly, there were probably too many venture capitalists, just as there were too many startups for a while. And so it's always painful to transition, but it's probably going to be good for the long-term health of the ecosystem.
Yeah. And what's been interesting is these, multi-stage funds who are sort of dormant, raising their subsequent funds right now through big investment banks or through, sort of other parties. Whereas that they're really not deploying all that much capital. That's something that we've had our eyes on and why we've enjoyed investing in really scrappy emerging managers. And I think we've focused kind of primarily on that.
Yeah, and I think fund size really matters. I think we need to talk about that as well. I have the ability to raise decent amounts of money. I had the ability to merge our fund with some very large multi-stage funds. And I looked at the economics as not solo GP anymore. I have a partner now, actually, Mike Savino. But as somebody who's traditionally been a solo GP and now a bunch of managing directors and a very large investment team for a $50 million fund, because I don't need the management fees, right? I've already had some big wins. So I am focused on, I think I'm never going to raise a fund above 50 million, because I think it keeps you more focused to put 25 million into 200 names, find the best ones. It might be 40 companies coming out of there, give them, 250K, 500K each. We talked about my portfolio management strategy before, and then find the top three and then just put another 2 or 3 million into each of those.
I was speaking with a really well-known sort of seed investor just this week. His journey was kind of the classic seed investor journey, where he started off by raising, I think, a $10 or $15 million fund, writing 150K checks into early stage startups with all his friends, raised a bigger fund after seeing some success, doing 300, 400K checks, and then raised, say, a $60 million fund, writing, I think, $1 to $1.5 million checks and leading deals. And that transition from this sort of fund 2 collaborative checks to fund 3, where effectively you're now competing with all your friends, meant that he couldn't work with his friends, meant that his deal flow dried up a lot, meant that he had much bigger obligations to all of the founders. And at a time where he thought he should have, been feeling successful and like a winner because now he was leading deals, he just started hating the job. And so 3 years after raising that fund, he just like, you know what, I'm done. I don't want to do this anymore. I want to go back to basics. I want to go back to the collaborative checks, sort of rebranded his firm, what have you, and is now loving life and working with his friends again, writing the small collaborative checks at the early stage. I think it was like a really, really interesting lesson is because what the VC zeitgeist tells you to do is raise bigger funds, go from collaborating to leading. And I just don't think that's the right approach for so many people.
You're so right. Donald, what are your thoughts?
I agree with that. I mean, I think that, it's really about the energy of the investor and making sure that, you're doing it because you love it, that'll help you get those economic returns. You have to make rational decisions around, whether you're going to do a secondary at some point in time, call it an investment you make in the early days, or, whether you're going to kind of maybe double down on the next round like you do, Jason, in some cases. But like, if you hate your life, you're never going to be successful. So I think, in this particular case, with this manager, I wholeheartedly agree that he should have retrenched.
It's nice to have a hurdle that you can hit and get into the bonus for everybody, your team, et cetera. And, and also I find with the management fees, it gets a little pernicious when, you start layering them on top of each other and it starts increasing. And then you're like, oh, there's a bunch of money sitting here. Should I hire another person? Or I could put it in my pocket. Oh, it's like, okay, I'm coming out of pocket for $1 million in salaries a year because I have such a great success with the media side of the business that's very profitable. I just underwrite like $1 million a year in extra salaries because I'm like, you know what? I'm going to hit, more unicorns, hopefully more decacorns. And then someday I'll hit another $100 billion company. And this time when I do, I'll own 10 or 15% of it, not, basis points. And so it's very easy for me to do the math to contribute, essentially $1 million a year to my funds because I know the value that can come out of this. And that's where I find when a manager figures out like their economics and what they love, Donald, to your point, you kind of get very dialed in and you don't need these external not virtue signaling, but status signaling moments. Like I don't care about a tombstone that says we raised 300. What I care about is how many bets did we place and who are just get me the 20 breakouts and get them, get them to our jam session. I want to spend 2 hours with them. I want to hear about the business. I want to meet the management team. And so now it's like, back to your point, Donald, you have to love doing this because it's too hard and painful and arduous as people are learning, and it's too stressful. If you don't actually love it, you're going to do a bad job at it. I wake up every day, can't wait to see that week which 5 companies my team thinks are the best out of the, we're up to 70 first meetings a week. And I'm like, give me the top 3, 4, 5. And they get me them with a little summary, a little mini deal memo. And we decide who goes to the next round, of meetings. Man, it's so enjoyable. And that is a critical part of life, and specifically the life of a venture capitalist, because so many things are out of your control. So you have to focus on process, the things you can control, how many meetings you take, how thoughtful your decision-making is, how hard you work for the company, and then how thoughtful you are about doubling down. And, it's not that difficult of a business if you keep it simple. Do a lot of meetings, give a lot of no's, and when you do invest, just bust your ass to get them to pull through to the next round of funding. And that's literally, every time we talk, David, I tell you what I'm working on. The thing I'm working right now on is pull through, which is what a lot of venture firms will look at. They'll put Techstars, Y Combinator, Launch, other accelerators next to each other and say, how many of them get their startups to the next round of funding? It's very low, 10 or 20% make it to that next round of funding. How many make it to Series A? Now you're at 5%. How many make it to Series B? 1%. And then for, seed stage firms, how many make it to Series A? 30, 40%. For Series A firms, how many make it to Series B? Okay, 50%, whatever it is. And so, you have to get good at each of those functions, and process is what it's about.
Yeah. I'd also kind of add that, philosophically, back to kind of the happiness point, if you're happy, if you're enjoying what you're doing with your fund, then that's going to trickle down to your founders, and you're going to be a great champion for your founders. You're going to bring that energy to your founders. And it might sound kind of superficial, but I think it's a contrarian view. And it has been over the past couple of years, at least, where people are pulling out their caliper and their surgical knives, telling founders, we need to cut back on our burn and do all kinds of other things. Whereas, like, if you're, you're the fan in the in the stadium when the Knicks playing and you're clapping, and you've got a whole bunch of other folks clapping, maybe the Knicks will win. So let's be great champions of our founders, and let's help them push through. I think that's sort of a really key thing to take into account as an investor, and just having kind of a well-rounded approach will enable people to do that.
Yeah, absolutely. I think one of the biggest signals, it's the most basic, but it is the most powerful, is GP commit. You mentioned, Jason, you're putting in essentially 5%, and that's 5 times more than the average person.
10%, actually. It's a $50 million fund. Yeah. So if over 4 years, I'm putting $1 million in cash in and then $1 million each year in like salary. So it's probably 5. So it's like 10. I like what Homebrew did. Over time, as, and I have like a family, like when I say I have a family office, I'm kind of running my own money myself and this like family office concept. And, I've been working on that with my wife and like what our goals are, over the next 25 years, 30 years that I got left of me to work. And we're like, you know what? Every time we look at investments, the best place to put it is my fund. So why would we do anything else and give management fees and carry to anybody else when I think I'm pretty darn good at this? So let's get more of our money into this. And that's, I think, I think that happened at Sequoia as well. The partner started putting in very large chunks of the funds.
Benchmark very famously as a huge amount of their LP capital. That is their former GPs.
I mean, if you're going to bet on somebody and you do this it's just interesting. Like people are like, oh, I have this I get contacted by, wealth managers all the time. Like when you become a VC, you get like an endless stream of founders emailing you, LPs emailing you, and then 2 other groups, private aviation. They email you constantly, and wealth managers. And these wealth managers are calling me and I'm just like, you want me to give you my money to do this? By the way, on the other side of your business, your wealth managers are calling me to try to get access for their high net worth individuals in our funds. Like, you're not going to do a better job than me at getting to 3x returns. I'm trying to beat the market here, 3 to 5x. Sorry, I'm not giving you my money to play with. If I was going to give my money to anybody, it's going to be real estate I can enjoy with my family, or venture capital that I have like, a really big edge on. Right? Like Michael Jordan playing baseball. Like, what are we doing here?
Well, there's even like some extreme situations. Several funds like SV Angel, you can't invest that early stage fund. That's just Ron Conway's money. Roger Ehrenberg, one of the greatest early stage investors, I think he's hit multiple 10x funds. He's like, screw this. I'm just taking my money and just investing my money. So when he invests in a company now through eBird Capital, that's just his own capital. So I think there's a lot of rationale. Unfortunately, for GPs and LPs, that's not the common thing, right? And you have GPs not aligned with LPs, and they're investing sometimes in other people's funds, more money than their own funds, which itself is a pretty disturbing signal.
I think like private equity is really far more mature than venture capital in this specific arena. And there's like 2 parts of it. One, it's expected that GPs in private equity invest significant amounts of their personal net worth in their funds. And there's a preferred return. And in venture capital, you have none of those. You have people at best committing their management fees, and there's no preferred return. And you put those 2 things together and you end up with some really bad behavior. So I say the preferred return because in venture capital, you could have a 10-year fund. You could make 2x, which is, just slightly more than effectively the 10-year treasury rate, and still collect a significant amount of profits, even though you've done nothing. And so you have these sort of 2 factors in venture capital, I think, that really mess up the incentives.
Well, let's do the math. I mean, you take a $100 million fund, you get a 3x net return, which by most measures is top quartile, sometimes top decile in some industries. That 3x return, you get back $40 million in carry at some point over 12, sometimes 14 years. You raise a $300 million fund, you have a guaranteed $60 million fund in day 0. So much so that you saw during the last bull market, platforms like Pipe actually borrowing you your management fees in year 5, year 6 back to you. So sometimes incentives can corrupt, and that's something that unfortunately we've seen across the industry.
Yeah, I really hope that this downturn in VC will help us fix some of those things, but I haven't seen anything yet that makes me think it really needs to be led by the institutions to demand better of like these structures in the LPAs. And I haven't seen any evidence they're doing that yet.
Yeah. I mean, for me, that the way that that's been reflected in a number of circumstances is that the, partners where, who are less committed to their funds don't monitor and don't work with their portfolio founders as much during challenging, market conditions. They don't get in the weeds with them because, it's water off a duck's back if it doesn't work out. Whereas folks who've committed, more of their net worth end up working much more closely with those founders, or much more passionate about, getting exits and ensuring success. They keep their eye on the ball. So I think it's a good insurance policy as well.
David, what's going on with this SVB's venture portfolio? I saw a headline. I haven't gotten caught up on it.
Yeah, absolutely. So the fire sale for Silicon Valley Bank is nearing completion. It took 14 months after the collapse that we talked about earlier in the episode. And this, SVB Capital, a lot of people don't know that they had one of the very top fund of funds really in the market. It was top decile for certain vintages. And they ended up, it was basically dragged down with some of the, it's a good part of their book. And it's now been acquired by Brookfield and Sequoia Heritage, pending bankruptcy approval. But it's something that's been ongoing. I know a lot of people had a lot of interest in that asset. I'm not sure how the process went, but it's basically coming to an end.
Anybody else hear any back channel about this, Josh, Donald?
Well, I know it took a long time to get this deal done. And speaking to folks at SVB, not in this part of the business, but the other part of the business, there's a big exodus of talent from this group during that 1 year period because everyone was stuck in limbo. So I think one question I would have if I was an LP in any of their funds, I mean, on one hand, the sale feels like a rescue for the platform. But on the other hand, the question is it really the same team? Are they still going to have the same access they had before? Because keeping a business effectively in bankruptcy and limbo isn't usually the best way to attract and retain talent.
I remember when SVB was looking at our funds, and part of their process was we want to have access to all of your investments in real time so that they could, I guess, establish banking relationships, whatever. So it was a very interesting approach. Again, back to no conflict, no interest. I'm not saying there's anything wrong with this, but you got a banking business. You got somebody who's early stage. Okay. I'm watching, these early stage, seed stage funds, Series A funds in real time. Man, I think it gave them like perfect visibility into the banking side of the business. And then on the banking side of the business, again, I'm not saying anything's nefarious here, but they're wiring, their clients are wiring money. Their venture clients are wiring money to companies. I got to think they're seeing that as well. And I don't think they're calling up saying, I saw Sequoia or Founders Fund send to you $10 million. Can we get a meeting? But if they saw like $10 million go from Founders Fund to a company and they research that company online and they're like, oh, you know what? Nobody's actually contacted this company. It was in TechCrunch 2 years ago. I guess fair game, right?
I think it also worked the other way, right? Because if you're Founders Fund and you have a company that wants a line or wants some venture debt, they're an LP in your fund. You give them a call and say, I have this amazing company. We're all in. We want to back it. Please, please take a look and give us your, sharpen your pencil and give us the best deal possible. So I think it really, everyone won from this, little insider's game.
It would seem that a variety of people from SVB Capital could spin out because they've got ridiculous LP relationships and start their own funds. That's something that I'm kind of keeping my eye on. And, there are kind of plenty of folks who are very, very senior, who'd been doing it for, call it 15, 20 years there, even longer, who are, definitely be on the horizon on that front, whether it be early stage investing or late.
One thing that's interesting, and you've seen some of these large asset managers go public, and they're almost always valued on their management fees. A lot of them end up being regret going public because the public markets don't really value the carry. Seems like that was probably the case here in terms of valuing it on its portfolio today. Josh, you brought it up about some of the talent leaving, but the way that it looks like it's structured to this new entity, which is Pine Grove, is a cash upfront of $340 million and significant earnouts if they're able to start new funds and launch new funds. So I think they are going to go out and hire staff and perhaps try to go back and hire some of the people that left as well. But it seems like it's been structured in a thoughtful way.
One thing I'd wonder is SVB got access just because there was a lot of great reason to give them access if you're a top Silicon Valley venture fund. I'm curious how Sequoia's competitors will feel, with SVB now being owned by Sequoia Heritage. Does Andreessen want to give an LP allocation to Sequoia? Do the other top funds? Because now there's a bit of competition here, and I know they sort of compete, sort of collaborate, and I really would love to know what they're talking about, having seen the headline.
Maybe they're just buying the asset to manage it because they're almost like a strip sale, and they're not going to have this be an ongoing entity. I wonder.
They do have Pine Grove does do a lot of these continuation vehicles. We talked about it, Jason, 4 or 5 episodes ago, how the GPs are semi-retiring and there's no one to continue the vehicle. But there are earnouts here that incentivize them to continue the franchise. So it'll be interesting, but it'll be another case study on what happens when markets go under and there's still assets. There's good assets that go along with bad assets, and how bankruptcy courts are able to navigate that.
All right. Should we talk about our last 3 investments?
We'll start with you, Donald.
Last 3 investments invested in a business called Slope that does B2B payments alongside Sam Altman and a variety of other folks, USV. It's an exciting one. I think, Sam Altman had this quote back in the day, hire for Slope, not the Y-intercept. So, hire for people who can learn really, really quickly and accelerate. And the founders are super young, building an explosively growing business. We think it's the next Stripe, if not much, much larger. And OpenAI is sort of, deeply involved in the business. I'll go on to number 2. Permit Flow. Founder is very mission driven, looking to help solve the housing crisis effectively. It's software for developers, builders, contractors. He kind of calls himself like the TurboTax of the space. You can do prep, submission, tracking across a whole bunch of municipalities across the country. It was really exciting, actually. In December, he was contemplating going out for a Series A, and literally the day he contemplated it, Kleiner Perkins came in and gave him $20 million at 100 post. And then because Felicis didn't get a look at the Series A, the next day they came in and they gave him a note at a different valuation, put it that way. So it was a really, really exciting funding round. And, he's seriously off to the races. I think this is one to track. And then Field Guide is my third. They do trust and auditing software. The founder came up with the idea at Atrium, if you remember Justin Kahn's startup. And it's, AI for advisory, attacking, call it Wolters Kluwer's or a portion of Thomson Reuters, grown extremely quickly. I was in the seed. I've invested, several times, and it's built for and by practitioners. It's evolved into a whole variety of verticals. Samir at Bessemer, who did, he's a CEO of SendGrid previously, led the Series B. So he's deeply involved in the business, and we're very excited. We think, this could occupy, a 500, I don't even know, plus $1 billion market.
Awesome. Josh?
Well, why don't I start with the company I helped start last year, Dexa. Dexa.ai. It's a search and answer engine for podcasts. So in the back end, we're transcribing and embedding audio from all your favorite podcasts. This one, All In, the Huberman Lab, Ferris, and many more. We're making it possible to quickly search and discover information without having to listen to the hours of podcasts. So if you're frustrated with having to miss some, you don't have enough time in the day to keep up with all your favorite podcasters, use Dexa to search, find summaries, and generally get all the amazing information that's trapped in audio and video.
What's the relationship, Joshua, with the podcasters? Because I know a couple.
Yeah, so we are currently powering Huberman Lab's search on his website. We have formal partnerships with some of them. We'd love to partner with more of them, but on balance, we're sending a lot of traffic back to every podcaster. So by and large, almost everyone, once they learn about what we're doing, is sort of really happy to be featured on here. Any
downstream concept of what you'll do with them in terms of revenue or that kind of stuff? Or
I think the most important part is first to get millions of users. This doesn't really matter unless we build a platform people want to use every day. And I think there's a bunch of options to monetize with subscriptions or special products for the podcasters themselves.
Yeah, it's a great idea. We're getting flooded with concepts in and around this, right?
I'd love to talk to you about it offline.
Well, it's clips, there's transcripts, there's summaries of transcripts. It's just kind of everywhere. And, my philosophy is like, okay, yeah, sure, as long as you send traffic back. And then I'm like, wait a second, my archive's worth something. Are you going to pay me a licensing fee for this? And so I'm like, I have 2,000 episodes of This Week in Startups almost, and 177 of All In. I'm like, should this be something where we get paid, or there's a revenue share, or we license it to but one company? So, I'm super curious as how this will hash out.
We'd love to explore it with you. I think all of those could make sense.
Yeah, cool stuff.
Oh, this is genius in terms of the dissemination of knowledge. I mean, no longer is Wikipedia our only friend. This is going to be massive.
Yeah, big space.
So jumping to the other two, yeah. So the second is a funder or person I just recently backed, Casey Caruso. Her fund is called Topology. She dropped out of Harvard. She's a machine learning wonderkind, true force of nature. She was working at Google while moonlighting at Bessemer. Then she was the fifth investing partner at Paradigm. She spun out recently to back deeply technical founders. She could easily be one. I think almost everyone she backs wants to hire her. She finds the incredible talent really early, and really gets behind them. And she herself is sort of a force of nature and the kind of person that you absolutely want to back. The third is a group called PowerSet. PowerSet arms top technical founders with their own mini funds to invest out of.
Oh, I heard about this.
Yeah, so this is Jake Zeller. He started doing this back at AngelList about 10 years ago. Related also to Spearhead after that. And so now he's out on his own group called PowerSet with a really interesting model, again, honoring top technical founders to sort of invest in their friends and back, great emerging companies.
It's really Sequoia Scouts program, right? And then it was like Scouts. And then I think Naval at AngelList did Spearhead, where they gave like a little micro budget. It's such a great idea. And it lets people try on venture, for 50K, 100K bullets. And
many of their original sort of scouts have actually gone on to become exceptional solo GPs in their own right. I think Yuri Sagalov got his start with an AngelList fund. Josh Buckley did.
I was the first syndicate AngelList.
There you go.
Wonderful. There you go. I've done 301 of them now. So I think, if you're, I was just talking to an intern we had, and we don't do internships, but one of our LPs asked us to do them a favor. And I was like, that's a favor that you're going to have to pay back 3x. You sure you want to do that?
No conflict, no interest.
And they were like, what do you mean by that? It means, I said, literally, if we don't do internships, I hate internships. If I take this person for 3 months, you owe me 3 equivalent favors. And they were like, oh, okay. And I was like, okay, it's your choice, because I don't like internships. So I was in a meeting with this intern, and he wanted to be a venture. And he says, well, what do I do next? And he had this really good hustler. And I said, don't join venture. So wait, that's my dream. And I said, go work at 3 startups, 1 to 2 years each. When you're 27 or 28 years old, you will have scar tissue, and then you'll easily be able to work in venture capital. And then this is just like a great little onboarding. I do wonder how these are set up, if they're one LLC, kind of fund.
So they're actually AngelList funds in the back end. So sort of structurally, it looks like a fund of funds.
Yeah.
And each of those individuals, if they want, can contribute their own capital alongside PowerSet's capital.
Right.
As a fully separate entity.
Got it. So that's even better, because now they're learning about fund management. So you're not abstracting all the pain of raising a fund, Josh, right? You got to grow up at a certain point and learn how audits work and all this stuff. And maybe $1 million fund doesn't have an audit, but it's just a lot of, it's going to be a lot of work. So I love this idea.
Training program and great way to, make money simultaneously.
Yeah. And look, he's been doing it for a decade too. So he sort of knows what to look for and which founders are more likely to be successful.
Who did you say was the principal there? What's his name?
Jake Zeller. And he's also got a partner, Jonathan Swanson, who's the founder of Thumbtack and Athena.
Oh, Jonathan, I was one of my best friends. Yeah. I didn't realize this was his thing.
Nice guy. I played poker with him a couple of times.
I was the first investor in Thumbtack.
Who won?
Different outcomes. I did okay. I did pretty well.
And I just so good at poker last night, I can't even talk about it.
Jason, I'm going to play with you for the first time.
Oh yeah, at the Liquidity Summit.
That's right. I'm excited.
Shout out Liquidity. This podcast has a event that I'm doing every year in June. Used to be called Angel Summit. This is year 6. It's called Liquidity Summit liquiditypod.com/summit. It's 125 people, about 25 of them are speakers. I think it's right now 60 GPs, high net worth individuals, and about 30 or 40 LPs. So it's just my way to hang out with the cool people you hear on this podcast. There's about 10 paid tickets left. If you're an LP, we let you, at this point, be my guest. So if you're an LP and you've invested in a fund in the last year, ping me and I'll try to get you, I'll squeeze you in with a free ticket, complimentary ticket. But David's going to be there, and the speaker list is bonkers, and a lot of the besties you know are coming, including 2 literal besties, Freeberg and Chamath. Is it my turn? Did you do 3?
It's your turn.
Josh?
You're up.
Oh, I'm up. Okay. All right. AI, super important. There's a lot of data out there, and we love using AI to take all the data out there and make sense of it in the world, right? Because data sets that were too expensive to do manually, you can just kind of discover things, seeing with protein folding, all kinds of stuff. So here's HomeScore. It goes out, it figures out through a bunch of proprietary machine learning, et cetera, if a home is a good investment or not. That's it. HomeScore.co. It is basically like Carfax for homes. It's that simple, folks. You don't have to overthink this stuff sometimes. Jenny AI is a company we incubated, and they have been in the AI space since ChatGPT 2.5 or 2. I know this because they were like, hey, Sam Altman, can you get us into this beta? And it was the early days of all this. If you've used Grammarly before to help with writing, you know about having like a sidekick. This is that for people who are writing professional papers. So here you see, if you're watching on the screen, if you're not, go to youtube.com and search for Liquidity, or go to liquiditypod.com. And here you see like being able to navigate through making an actual professional paper in academia and put citations in it. And Stanford, Penn, Oxford, it's really amazing. And you can go check it out at Jenny AI. For my final one, which one should I go with? Actually, I'm going to go with Sparkplug. This is a really interesting company that went through our accelerator a couple of years ago. And one of our jobs that we're getting better at as a fund is knowing the winners in our own portfolio. Man, is it hard to keep track of all these companies. And we've really got a handle on that because we built a platform to do it. And, one of our associates is like, hey, JCal, you're going to need to look at Sparkplug because the chart's up and to the right. It turns out one of the big problems retail has, and the people who put their products in retail, is incentivizing and engaging and educating people who work in retail. So they created a platform for, let's say you made an electronic device, or any complicated, a coffee machine that would be at Williams Sonoma, et cetera. They figure out a way to educate and then give credit to the people who sell more Juras of coffee machines, or, Terra Cafe, TKO2. And it's very simple. They give them a dashboard. If you measure it, you can manage it. They educate them, and then they unlock rewards. This seemed to me like an interesting business to make a small bet on. And then we just kept increasing our position. And I am just super delighted with their progress. If you're in retail and you want to have a better staff and have them be more motivated, they're now powering 2,500 retailers and 500 brands. So zip, zip, zip. And as you can see here, it increases sell-through and it retains employees. It incentivizes sales, and it's easy to install. I hate to be a proponent for this, but sometimes things seem very small when we see them in the accelerator or founder university. It just feels like it gets dismissed as a feature. And then we watch that little feature be a wedge. And then these smart founders, they just keep banging that wedge into this giant stump, and it cracks open. And man, boom, all the money and engagement and customer love pours out. So Sparkplug.app is my third choice, Jenna.ai, my second, and HomeScore, my first. I'm not putting them in that order, but HomeScore.co. I really want to make sure you check these out. And if you're listening, the number one thing you can do for a founder is just go check out their website and their company. And if you know somebody who could benefit from it, just email it to 3 people who could benefit from it. So if you know somebody in retail or in products in retail, just please help them out here, or somebody who is buying homes. This is a good panel. Nicely done, David. David, you're learning to be a great moderator under my tutelage. Every week you get better. But
really,
really,
life hack: put yourself in a room where you don't deserve to be in, and surround yourself with great people. And you're
humble
up.
about it.
Not immediately.
Every episode, it's like, how did I do? Could I do better here? And I give a little note every 3 episodes. I don't try to give them too many notes. But your superpower, David, is you are a connector. You're a connector, and you're just so great at booking these amazing guests. And if you want to read a good story, I never shared this before. When I was a young pup in New York, there was a magazine called The New Yorker. And in 1999, this magazine wrote a story about me, Larissa McFark. And it was called The Connector. It's so long ago. Look at that young guy with the bulldog there. It's my bulldog Toro. I wrote this story about me called The Connector. And the backstory on it, it's a pretty funny story. Larissa's like, hey, I want to interview you. You're like this larger than life figure here in Silicon Alley in New York, with this magazine, Silicon Alley Reporter, about startups. And she says, meet me at this cafe. We both lived in West Chelsea, and we meet over there on 13th and 9th Avenue, 10th Avenue. She said, I'm going to bring my friend Malcolm. I said, okay, sure, bring your friend Malcolm. Shows up with this kid with crazy hair. And I'm like, what's your story? And he's like, oh, I'm Malcolm Gladwell. And you, my friend, are what's called a connector. This is before he'd written, any of the books. What was that first book he wrote?
Tipping Point.
Tipping Point.
Yeah.
And in the Tipping Point, it's like, there's a thing called the Dunbar number. In the Dunbar number, there are connectors. You tell them the name John, and then a group of people, if they know Joshua or Donald, they'll know 27 on average. And the average person knows 4. You're a connector. So they named it the Connector, and then he came out with the book. And then, David, what I'm telling you is you have that skill as well. You just know a disproportionate number of people with the first. If I asked you to list everybody you knew with the name Joshua or David or John, you would rattle off 20. It's like a really good superpower to have.
I appreciate that.
Anyway.
Well, it's been another great episode.
Incredible.
For everybody on the panel, for Joshua Berkowitz, Donald Stalter, Jason Calacanis. This is your host, David Weisburd. Thanks for listening.